Ladies and gentlemen, the Asian man is here. You know, sometimes reality is stranger than fiction. If you had told me a week ago that the global silver market, a market worth hundreds of billions of dollars and central to both industry and investment portfolios, would suddenly find itself on the edge of existential stress because of a political tariff threat, I would have checked my sources. But here we are, Sunday, January 18th, 2026, and the world has just changed. By now, you have probably seen the headlines. A presidential announcement proposing a 10% tariff on imports from several European nations, linked to a bizarre negotiating posture over Greenland, sent shockwaves through markets almost immediately. This wasn't a slow-moving policy change. It was a headline that repriced risk in minutes and rerouted capital flows. Investors reacted fast. Safe haven assets leapt. The dollar weakened versus major currencies. And precious metals, already tight after a blistering 2025, jumped sharply as traders and industrial buyers scrambled to reassess inventories and delivery risk. Silver, in particular, spiked to levels we hadn't seen in years as the market priced in not only higher demand, but also a higher cost and risk of physical movement. To understand why a tariff headline can look like a nuclear bomb to silver traders, we have to map how the market actually functions. There's the physical layer, the bars, coins, and refined metal you can hold, and the paper layer, futures contracts, ETFs, and interbank claims that can move ownership on paper without metal crossing borders. The paper layer depends critically on fungibility and liquidity, that a bar in London is functionally substitutable for a bar in New York, and that movement or substitution can happen quickly and cheaply. That fungibility is what a 10% tariff threatens. Tariffs change trade economics and add friction to movement. Banks and vault operators begin to reassess counterparty risk and delivery channels. When shipping and cross-border transfers become more expensive or politically risky, physical metal gets hoarded where it already sits. That concentration amplifies local shortages and forces premiums higher, the exact opposite of what a globally fungible market needs to function smoothly. We also must remember the background into which this political shock landed. 2025 was an extraordinary year for silver. Prices surged dramatically last year, driven by a mix of strained mine supply, rebounding industrial demand, and record investment flows, leaving many London vaults and market inventories far thinner than typical seasonal patterns would suggest. The LBMA's recent reports show how exceptional the prior year was, and that makes the market more brittle to sudden shocks today. Now, imagine a market where inventory buffers have already been run down and headline-driven demand pops again. The London system matters here because LBMA-approved vaults and the network that routes metal through them are the plumbing for the paper market. If those vaults are low, and several market monitors had already reported steep declines in London inventories in recent months, then any incremental shock becomes magnified into a scramble. Spreads widen, delivery windows slip, and counterparties begin to hoard rather than deliver. That's the practical transmission mechanism from a tariff tweet to a market squeeze. So who gets hurt and how? Industrial consumers, manufacturers of solar panels, electronics, and medical devices, have less time to secure metal at predictable prices, which raises input costs and complicates production planning. Bullion banks and refiners face a triage problem. Who gets delivered first? The long-only investors, the industrial buyers, or the exchange and clearing obligations. Speculators and retail traders face violent margin calls as volatility spikes and liquidity evaporates. Are there guards in place? Yes, central clearing, margin rules, and position limits exist to blunt some domino effects. But a policy shock of this kind is not the sort of stress those systems were optimized around. Models assume incremental policy shifts, not headline-driven geopolitical brinkmanship. When behavior changes, when actors start choosing to hoard physical metal rather than obey the usual delivery patterns, the protections that worked in calmer regimes can be strained. It's worth stressing that the tariff announcement did not create the structural imbalance on its own. Instead, it acted as a catalyst that exposed and accelerated an imbalance that had been forming. Tight supplies, rising physical demand, thinning inventories in key hubs, and a large paper position base that depended on the ability to move metal cheaply and quickly. Policy shocks reveal fragilities, and when they meet a market already pushed to the edge by fundamentals, the result can be messy and fast. Lastly, if you are wondering about the London connection beyond inventories, the LBMA remains the center of the global settlement and vaulting system, and refiners and vault administrators continue to update their good delivery lists and operational practices to adapt. Even administrative changes, such as additions to the good delivery roster, matter because they change which bars and refineries can flow into which vaults and with what confidence. These operational details are not glamorous, but they are how the market actually clears. This is where the story stops being political theater and starts becoming a structural financial event. Because once you understand how silver actually moves, not on Twitter, not in headlines, but inside vaults, balance sheets, and settlement systems, you realize something uncomfortable. This was never really about Greenland, and it certainly wasn't about a joke. This was about control. This was about leverage, and this was about the dollar-based commodity system finally running into a physical wall. Let's talk about the part nobody on mainstream television is explaining, the LBMA. The London Bullion Market Association is not an exchange in the way people imagine markets. There is no flashing screen with bids and offers. There is no open outcry. The LBMA is a clearing and settlement system, a trust-based network where trillions of dollars worth of precious metals claims are netted, offset, and rolled forward every single day. London is where silver becomes global. When a bank in New York sells silver futures, it assumes, implicitly, that silver can be sourced from London if delivery is required. When an ETF issues new shares, it assumes that approved good delivery bars can be mobilized, reassigned, or rehypothecated through London vaults. Everything depends on one assumption, that silver in London is freely interchangeable with silver everywhere else. This is fungibility, and fungibility dies the moment you introduce tariffs, friction, or political risk into physical movement. A 10% tariff doesn't sound dramatic to the average person. It sounds like trade noise. But in bullion markets, margins are razor thin. Transport costs, insurance, vault fees, and financing already eat most of the spread. A sudden tariff turns arbitrage from profitable to impossible overnight. And when arbitrage dies, the system fractures. Here's how it normally works. Silver trades at a premium in New York. Banks notice the spread. They pull silver out of London vaults. They ship it, swap it, or paper transfer it. The spread collapses. The market stabilizes. That process is what keeps global prices aligned. Now imagine that process breaking. Not slowing down, breaking. The moment tariffs are announced, risk managers do something very simple. They freeze movement. They stop committing metal until costs, legality, and counterparty exposure are reassessed. Silver doesn't move, but paper claims keep trading. That's the crack. Because paper silver is infinite, but physical silver is not. This is where the phrase LBMA cutoff starts circulating. Not because London officially shuts its doors, but because effective access disappears. Bars exist, but they are no longer economically or politically mobilizable. And markets price that instantly. You could see it in the spreads. You could see it in lease rates. You could see it in the scramble for immediate delivery contracts. And most importantly, you could see it in the behavior of bullion banks. They stopped playing whack-a-mole. For decades, banks have managed silver shortages by shuffling claims. When demand rose in one place, they leaned on inventories somewhere else. It was a game of timing, netting, and confidence. But confidence only works when participants believe the exits are open. Tariffs close exits. And that forces a decision every bank hates making. Do we deliver metal, or do we cash settle and admit there isn't enough? That's the nuclear option. Because once cash settlement becomes normalized, silver stops being a commodity and starts behaving like a controlled asset. This is where the dollar comes in. The global silver market is dollar priced. Futures are dollar settled. ETFs are dollar denominated. Financing, margin, collateral, all of it flows through the dollar system. But here's the paradox. The more the dollar system tries to control silver, the more it exposes its dependence on it. Silver is not just an investment metal. It is industrial, strategic, irreplaceable in electronics, solar, defense systems, medical devices, and energy infrastructure. You can't print silver. You can suppress its price. You can delay delivery. You can settle claims in cash. But eventually, industry needs atoms, not dollars. This is why industrial buyers were quietly panicking while media laughed. A solar manufacturer doesn't care about Greenland jokes. They care about delivery timelines. A defense contractor doesn't care about politics. They care about supply assurance. When LBMA mobility falters, industrial users go direct. They bypass exchanges. They bypass ETFs. They sign long-term offtake agreements. They remove metal from the system permanently. That is how inventories vanish. And once inventories vanish, price becomes irrelevant. The price you see on a screen no longer represents availability. Only the last traded illusion. This is also why ETFs matter here. Silver ETFs rely on authorized participants, mostly the same bullion banks, to source and allocate metal. If those banks hesitate, ETF creation stalls. Premiums rise, discounts flip. Retail investors suddenly discover that backed by physical doesn't mean redeemable for physical. And once that realization spreads, trust evaporates. Now zoom out. Why now? Because silver entered 2026 already stretched. Mine supply growth has been weak for years. Ore grades are declining, energy costs are higher, environmental permitting is slower, new projects are scarce. At the same time, demand is structurally rising. Solar installations, grid upgrades, EV infrastructure, defense spending, medical technology. This is not cyclical demand, it is secular. So when a political shock hits a structurally tight market, price doesn't just spike, it revalues. That's the difference. A spike fades, a revaluation resets the floor. And this is where people misunderstand what killed silver really means. Silver wasn't killed, the old silver system was. The system that assumed infinite liquidity, infinite mobility, And infinite paper substitution just ran into reality. The tariff didn't create scarcity, it exposed it. The LBMA didn't collapse. Its limits were revealed. The dollar didn't fail. Its leverage weakened. And once that happens, the market never goes back to pretending. From here, every participant behaves differently. Banks reduce short exposure. Producers demand better terms. Governments reassess strategic stockpiles. Investors stop trusting proxies. And most importantly, silver stops being priced like a forgotten metal and starts being treated like a strategic resource. This is why you're seeing language shift. National security, supply chain resilience, strategic materials. These words don't appear in markets unless policymakers are already behind the curve. So when you hear that a 10% tariff just killed silver, understand what that really means. It killed the illusion that silver was abundant. It killed the illusion that paper claims equal metal. It killed the illusion that politics can't touch commodities. And once illusions die, markets don't calm down. They reset. This is the moment where markets stop reacting and start repositioning. Because once a structural crack appears, capital doesn't wait for confirmation. It moves first and asks questions later. And what we are witnessing now in silver is not panic. Panic is loud, emotional, and short-lived. This is something far more dangerous to the existing system. This is strategic repricing. Let's begin with the question everyone is suddenly asking: how high can silver really go? That question assumes silver is still being priced as a commodity. It isn't. It is transitioning into a strategic material with monetary side effects. And assets like that are not priced by cost of production or historical ratios. They are priced by availability, control, and trust. To understand where silver goes from here, we need to understand what just broke. The old pricing model assumed global fungibility, reliable arbitrage, stable paper-to-physical conversion, centralized price discovery. At least 3 of those assumptions are now compromised. And when assumptions break, models break with them. This is why analysts anchored to old price targets look increasingly irrelevant. Let's talk scenarios. Scenario 1, $100 silver, the controlled reset. This is the outcome policymakers would prefer. In this scenario, silver moves sharply higher, but not explosively. Governments allow prices to rise to a level that destroys excessive demand, encourages recycling, keeps industrial users operating, prevents panic buying. $100 silver is not a moonshot in this context. It is a rationing mechanism. At that level, marginal industrial demand is deferred, substitution accelerates, and investor demand slows temporarily. But here's the problem. $100 silver does not solve the inventory problem. It slows the bleeding, but it doesn't refill vaults. And more importantly, it doesn't restore trust in paper claims. Once market participants realize that price can be managed but delivery cannot be guaranteed, behavior changes permanently. So $100 silver is not an endgame. It is a pause. Scenario 2, $150 silver, the confidence break. This is where things get uncomfortable. $150 silver implies one thing very clearly. Paper leverage has been reduced violently. At this level, short positions are no longer manageable through rollovers. Margin requirements explode. Banks are forced to close exposure or source metal at any price. This is also where ETFs start behaving strangely. Creation units lag, premiums persist, authorized participants hesitate, retail investors notice, and once retail notices that liquidity is conditional, inflows accelerate rather than slow. Why? Because silver becomes a trust trade, not a price trade. People buy not because it's cheap, but because it's there. At $150, governments start paying attention, not rhetorically, operationally. Strategic stockpiles are reassessed. Export controls are discussed quietly. Industrial allocations are prioritized. This is where silver begins to resemble uranium or rare earths, markets where price is secondary to access. Scenario 3, 200 plus silver, the systemic event. This is not a forecast, it's a failure mode. $200 silver implies one or more of the following. Cash settlement becomes normalized. A major bullion bank exits short exposure publicly. Industrial users bypass exchanges entirely. Governments intervene directly. At this point, price discovery ceases to be centralized. Silver trades in tiers, one price for industry, one price for financial settlement, one price for physical possession. This is how markets fracture. And once fractured, they do not easily recombine. Now, let's talk about governments, because they are not passive observers here. Governments hate volatility, but they fear shortages more. A volatile price can be explained. A missing supply cannot. So what tools do they have? Export restrictions, strategic reserve releases, industrial prioritization, market rule changes. None of these are hypothetical. Every commodity crisis in history uses some combination of them, but here's the catch. Silver is globally distributed in production, but centrally controlled in pricing. That mismatch limits what governments can actually do. You can restrict exports. You cannot force production. You can change exchange rules. You cannot create metal. And the moment governments start intervening, they signal scarcity, even if they deny it publicly. That's why smart money moves before policy announcements. Which brings us to the most important part of this story. What is smart money doing right now? They are not trading silver. They are acquiring it. Physical, allocated, off-exchange, long-term. No leverage, no proxies, no promises. This is not retail behavior. Retail chases price. This is balance sheet behavior. Family offices, sovereign funds, industrial conglomerates. They are locking supply. Because in a fractured market, ownership beats liquidity. This is also why miners are behaving differently. Instead of hedging aggressively, many are allowing exposure. They want upside participation, they want pricing power, long-term offtake agreements are being renegotiated, royalties are being reassessed. Silver miners, long treated as leveraged price bets, are becoming strategic partners. That shift alone changes valuation dynamics. Now zoom even further out. What does this mean for the dollar? This is subtle but critical. The dollar does not collapse because silver rises. The dollar weakens when commodities stop responding to price signals. If price cannot summon supply, currency loses authority. And that is the real risk policymakers face. Silver is not large enough to break the dollar, but it is visible enough to expose stress. It becomes a signal asset. When silver breaks, people ask, what about copper? What about uranium? What about oil? That's why this matters. This isn't about silver bugs being right. It's about the system being fragile, and fragility spreads. Finally, let's address the psychological shift. For decades, silver has been mocked, too volatile, too small, too manipulated. But markets have a strange habit. They punish complacency and reward patience. Silver sat ignored while leverage built quietly on top of it. And now, when it matters most, it refuses to cooperate. That's not poetic justice. That's mechanics. So if you're asking whether this is over, the answer is simple. Events are over. Processes are not. Tariffs may be negotiated. Headlines will fade. Politicians will move on. But silver will remember. The market has learned something it cannot unlearn. That delivery matters more than price. That paper depends on trust. That control is not the same as ownership. And once those lessons are absorbed, the game changes permanently. So no, silver wasn't killed. It graduated. This is where the story stops being about silver and starts being about truth. Because by now, if you followed this chain of events carefully, you already understand something most of the market still refuses to accept. This was never a surprise. It was a reveal. Markets don't break suddenly. They crack quietly over years, while participants convince themselves that tomorrow will look like yesterday. Silver did not explode out of nowhere. It spent decades being leaned on, stretched, ignored, and underestimated. And then one day, it simply stopped cooperating. That is how systems fail. Not with chaos at first, but with silence, with delays, with temporary measures, with explanations that grow longer as confidence grows thinner. The Greenland tariff headline will fade. The jokes will stop. The news cycle will move on. But the silver market will not go back to sleep. Because something irreversible has happened. The market has seen the limits of control. Let's talk about what this really means. Not for traders, not for speculators, but for the structure of modern markets themselves. For decades, financial systems have relied on a single foundational belief, that liquidity can always be created faster than demand. This belief underpins derivatives. It underpins ETFs. It underpins central clearing. It underpins modern risk management. But liquidity is not supply. Liquidity is permission. Supply is reality. Silver just reminded the world of that difference. And once a market relearns that lesson, it never fully forgets. Now, let's address the question many viewers are silently asking. What does this mean for regular people? Not as an investment strategy, not as financial advice, but as understanding. The biggest mistake retail participants make during structural shifts is focusing on price instead of access. They ask, should I buy? Should I sell? Is it too late? Those are trading questions. Structural shifts require different questions. Who controls supply? Who guarantees delivery? What happens if rules change mid-game? What assumptions am I relying on that others may abandon? Because when systems fracture, the rulebook is rewritten, often quietly. In previous eras, these moments were obvious. Gold confiscation, oil embargoes, currency pegs breaking. Today, they are subtle. A change in settlement terms, a delay in delivery, a new clause in a prospectus, a temporary cash settlement option. Nothing dramatic. Until it is. This is why historical parallels matter. Silver has been here before. In the late 1960s, governments suppressed silver prices while demand exploded. The result wasn't stability, it was withdrawal. Coins vanished, Hoarding increased. Eventually, the system snapped and silver was demonetized, not because it was obsolete, but because it was uncontrollable. In 1980, silver spiked violently, not because people suddenly loved silver, but because trust in financial assets wavered. And in every major commodity crisis, the pattern is the same. First, authorities deny scarcity, then they manage optics, then they change rules. Finally, they admit reality, after price has already done the damage. We are still early in that sequence, which brings us to the most misunderstood part of this entire episode, the role of narratives. Narratives exist to preserve confidence. They simplify complexity. They assign blame. They reassure participants that systems are functioning. It's just politics. It's just tariffs. It's just volatility. It's just speculators. These narratives are comforting, but they are also dangerous because they distract from mechanics. Silver didn't react because of a speech. It reacted because mobility, fungibility, and trust were simultaneously questioned. That combination is lethal to paper-heavy markets. Now let's talk about the LBMA one final time, not as an institution, but as a symbol. London represents the idea that markets can be centralized, netted, and abstracted away from physical reality. And for a long time, that worked. Until scale became leverage, until leverage became dependency, until dependency became fragility. This is not a moral judgment. It is an engineering one. Systems designed for efficiency are rarely designed for stress. Silver just applied stress. And stress reveals design flaws, which leads us to the end game, not in price terms, but in structural terms. The silver market is now splitting into 3 layers: paper silver, liquid, fast, abstract, confidence-based; allocated silver, slower, contractual, controlled; possession silver, scarce, immobile, sovereign. These layers will coexist, but they will not be equal. Price signals from one will increasingly fail to represent the others. That divergence is what people will eventually call manipulation. But it's not manipulation, it's segmentation. And segmentation is what happens when trust becomes selective. Now let's be very clear about something. This is not the end of markets. This is not the collapse of finance. This is not a call to panic. It is something more subtle and more permanent. It is the end of complacency. Markets will continue to function. Prices will continue to print. Trades will continue to clear. But behavior will change. And behavior is everything. Banks will be more conservative. Industrial users will be more protective. Governments will be more interventionist. Investors will be more skeptical. And skepticism is the enemy of leverage. That is why this matters beyond silver, because silver is not systemically large, but it is systemically revealing. It shows what happens when a small market breaks first. It shows the fault lines. It shows where confidence is borrowed rather than earned. And once those fault lines are visible, capital adjusts, quietly, patiently, relentlessly. Now, before we close, there's one final misconception that must be addressed. The idea that this story has winners and losers, that framing is too simple. Structural shifts don't reward intelligence alone. They reward alignment. Being right too early feels like being wrong. Being wrong too long feels like stability. Until it doesn't. Most participants didn't fail here. They trusted a system that had worked until it didn't. And that's not stupidity, that's human. The danger is not trusting systems. The danger is assuming systems are permanent. They are not. They evolve, fracture, and reassemble. Silver is simply one chapter in that evolution. So when future historians look back on this moment, they won't talk about Greenland. They won't talk about tariffs. They will talk about the moment when physical reality reasserted itself over financial abstraction, when delivery mattered again, when ownership mattered again, when promises were questioned. That is the real story. And finally, let's end where we began, with perspective. This channel is not about predictions. It's not about fear. It's not about selling certainty. It's about understanding systems, especially when they stop behaving the way we expect. Silver didn't break the world. It reminded the world that systems built on confidence must periodically prove they deserve it. And right now, silver is asking the questions markets hoped would never be asked. Who actually owns what? Who gets metal when it's scarce? What happens when rules change? And how much of what we trade is real? Those questions don't disappear. They linger. They reshape behavior. They define eras. So no, this is not the end, but it is the end of pretending. And that, more than any price move, is what makes this moment historic.